the activity that goes on 0-day and 0-day options, it's very distinct from the typical volumes that we see in longer dated options, right? So for example, institutional investors coming to hedge, like we mentioned, right, recession risk, or, they want to put on a hedge going to year end. That hedging flow, right, that's not going to be replaced by 0-day options, right? It's true that the VIX does not reflect the activity that's going on in these 0-day options.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everybody. Welcome to another edition of IBKR Podcasts. I'm your host today, Steve Sosnick, Chief Strategist here at Interactive Brokers, and I'm very pleased to acknowledge my guest today, Mandy Xu, Vice President and Head of Derivatives Market Intelligence at the Cboe. And obviously, there's a lot we can learn from the people at the Cboe. They do a great job in terms of market stats. Mandy, why don't you take a few minutes and introduce yourself to the audience, please?
Sure. Thanks, Steve. And I'm very happy to be here. So I recently joined Cboe after 13 years on the sell side, where I was, head of equity derivative strategy at Credit Suisse. And what I'll be doing at Cboe is producing a lot of client-facing content and market commentary around Cboe's leading suite of volatility products, including obviously the VIX, S&P options, et cetera.
That's wonderful. Tell me how you ended up in the strategist role at Credit Suisse before you started at Cboe.
Sure. So I actually interned at Credit Suisse straight out of college. Well, actually, while in college, and during my internship, I rotated on the equity derivatives desk, and I loved it. I loved the fact that it was a little bit more quantitative. And then when I joined the desk, there was an opening on the strategy team. And I like that, it was a combination of quantitative and qualitative, right? So there's a lot of data analysis, looking at, option Greeks, what's going on, with the data in the market, but also a big component of obviously is kind of distilling all of that data into actionable market themes and trade ideas for clients. So, to me, that strategy role was kind of the perfect combination of what I like to do, which is kind of dig into the data, but also using the data to tell a story about what is happening in the market.
Wonderful. Well, you were actually at this game longer than I have, because I came to it after 25 plus years as a market maker and sort of blundered into the strategy role. So I think I think it'll be fun to talk to someone who approaches the same topics with a different perspective. Let's dive right in. We can't have a discussion about volatility, especially one involving the Cboe, without asking, what do you see going on with VIX? Most people came into 2023 expecting higher market volatility, but what we've gotten instead is a VIX that fell steadily for much of the year, hitting a 3-year low of just over a 12 handle in June. What do you see as the main drivers of this, and where do you think most people frankly got it wrong?
To your point, most people came into this year very much expecting, I think, a repeat of last year, right, which is, elevated levels of volatility on the back of macro uncertainty. And to me, the move in the VIX this year is actually really very much fundamentally driven. It's a reflection of the fact that the macro environment has changed, right? So we came to this year expecting, sticky inflation, potential hard landing, recession, and instead what we have gotten is inflation that has fallen very, very rapidly, right? From a high of, I think, almost 10% last year to a low of 3% now. Sure, it's not at, the Fed's 2% target yet, but we're well on our way there. And at the same time, unemployment remains at historic lows, right? So we are very much in this Goldilocks situation. And that's why you're seeing volatility decline, not just for stocks, not just for equities, but across asset classes, right? So, not just the VIX that's fallen to near 1-year lows, but we're also seeing credit volatility, rates volatility, FX volatility, oil, commodities. Across every single asset class, volatility has fallen substantially. So that's why I think most, if not all of the move is very much fundamentally driven. Now, in addition to that, though, when we're talking about equity volatility and particularly the VIX, one thing to highlight is the role that correlation and dispersion kind of play into the level of the VIX. So keep in mind, that the VIX is a measure of S&P 500 index volatility, right? So the S&P 500 index, it's a function of obviously not just the volatility of the individual stocks, but also the correlation of those stocks. And the way that I explain it is that, if you take it to the extreme of, simplify it to an index of just two stocks, equal weighted, one stock goes up 20% in a day, another stock goes down 20% in a day. At the index level, right, that's unchanged. So high stock volatility, but very low index volatility in an environment of extreme dispersion or low correlation. And that's what we've seen this year. So S&P correlation went from levels, ranging 40 to 50 last year to a low of 8% earlier this year. And to put that in context, that's pretty much at or near a historic low. The last time we saw index correlation levels at that extreme was in 2017, which was a record low vol year for the VIX when the VIX was at 9, right? So the move in correlation, the decline in correlation of the stocks in the S&P 500, I think is another major contributor to why the VIX has been so low. And the macro reason for that, obviously, is this decline in recession risk. So that allows investors to move away from looking at the macro to now picking, to more stock fundamentals and stock picking.
Two follow-ups to that. First of all, how can our listeners follow correlation and dispersion? The concept is that you described is rooted in covariance and situations of that nature. And when we had a situation where essentially 7 stocks were going up and 493 were treading water, that fits into it. But the numbers you threw out, where can our listeners access those type of statistics?
Great question. So historically, traditionally, correlation dispersion have been, I would say fairly esoteric topics or esoteric subjects. But at Cboe, actually, we tried to make it more transparent and easier to follow and track for the end user. So we do actually have a number of correlation indices, 1 month, 3 months, 6 month, 1 year. So depending on the tenor that you're looking at, implied correlation indices for the S&P. So that is the numbers I was referencing earlier. That's based on those indices. And then just to kind of as a heads up, we're also going to be launching a dispersion index next month. So more to come on that, but we're definitely trying to make these subjects and these topics more transparent and easier to access and easier to follow for investors.
I love when I blunder into new product announcements from
you teed it up
guests.
Perfectly for me, yeah.
But, of course, one thing to keep in mind is, you talked about the record lows in late 2017. Those of us who've been in the business for a while remember how that came to an end in 2018. So at some level, do you feel that complacency becomes extreme? We're off the lows of VIX now. Just so people understand it, we're taping this in the afternoon of Wednesday, August, what's today, the 9th? Wednesday, August 9th. When I came into the room, VIX was about 16, off its lows of 12 and change. Do you think that investors are getting a little complacent, especially when we head into a seasonal time? And especially because some of the risks that were perceived earlier in the year, while you acknowledge that they've dissipated, they've not evaporated. So what's your feeling on investor complacency versus, well, let's just put it fear and greed?
So let me address it in two ways. So first, with regard to longer term risks, such as risk of recession, policy risk, policy mistake, from the Fed, those risks, like you have pointed out, they've dissipated but not evaporated. However, the VIX is not the index to be looking at for measures of these longer term risks, right? So just keep in mind the VIX by design, it's a measure of 1 month implied volatility for the S&P. So in layman's terms, how much the S&P 500 index is expected to move in the next 30 days. That's it, right? So you very much could have an environment like now where the VIX is low, but still you have these elevated or potentially elevated longer term risks. To really kind of get a sense of, is the options market, is the derivatives market appropriately pricing in these longer term risks? You have to look at the entire volatility curve. So in this instance, looking at longer dated implied volatility for the S&P. So for example, if we look at 1 year options on the S&P, I think that would give you a better sense or a better gauge of how markets are pricing in, longer term risks like recession, et cetera. So If we look at the S&P curve right now, it is true though, longer dated, vols have come in actually pretty significantly over the past 2 months. So 1 year, S&P 1 year at the money implied volatility, went from 18.5 at the beginning of June to as low as 15.5, right? A decline of 3 points in the span of a few weeks. That's pretty notable. And more importantly, the current level, it's right around the long-term average. So at least, longer dated implied vols in S&P, not really trading at, elevated levels currently. So I do think that is a reflection of the fact that, at least in the options market, people do see recession fears as easing. And I think, it's no coincidence it's happening at the same time as, major banks are reversing their recession calls as we have continued to get, good economic data. What tenor are you looking at when you're trying to make an assessment of risk? It really matters. And the second, and I think even more crucial point, is that a lot of times people think low VIX means that it's complacent. High VIX means it's, there's a lot of fear in the market. I don't think that's necessarily true. I think you can have, VIX that is low, but actually pricing in a lot of fear, as well as, VIX that is trading high, but not actually pricing in appropriate amounts of risk. So for example, last year, VIX was elevated, right? But it was not trading rich. This year, similar, I would say, to what we saw in 2017, if you look at where the VIX is trading versus where the S&P is realizing in terms of realized volatility, that spread or that difference, people often call that the volatility risk premium. It's a function of how much risk aversion is being priced into the market. That spread is actually very, very elevated right now. Depending on the tenor you're looking at, it's either near 1-year highs or at 1-year highs. Right. So S&P 3-month implied volatility, for example, right now being priced about a 4-point premium to realized volatility. So that is that I think is a sign that even though the absolute level of the VIX is low, I do think there's still a healthy amount of risk premium being priced into the derivatives market, and that you can see in the VRP.
People who I've been listening, have to suffer through my pontification, have seen, I've put that link to the Cboe definition of VIX in my pieces. It's like bookmarked there, and I just drop it in, how it's the market's best estimate of the volatility over the coming 30 days. And I've also said way too many times, VIX is not a fear gauge. It just plays one on TV. But I do find that one of the analogs, at least, not sort of day to day, but when you get to turning points, is VIX is the price of parachutes when a plane hits turbulence. And when the plane is zooming along at 30,000, because this comes from my experience as a market maker. Nobody really wants the umbrellas when there's a drought. Nobody really thinks about a parachute if the plane is moving along smoothly. As soon as you hit some turbulence, or as soon as the rain clouds develop, people want them, and they want them in a hurry. And VIX, to me, is still the most efficient way for an institutional manager to hedge his or her risks. To just, I want to de-risk quickly. And I think that explained a lot of what was going on in 2022. Was the initial down wave caught a lot of people by surprise. Everybody was on one side of the trade for the most part. And we started going down, and people needed to de-risk in a hurry. And as the year went on, VIX declined, because as people sort of got on side, as they got more comfortable with the level of risk in their portfolio, it still remained relatively elevated because the historicals were relatively elevated. What is interesting to me is that over just the past couple of weeks, and the day that it really struck me was when Nikkei reported that the BOJ was making its moves, and I was scheduled to go on TV at 3:00 that afternoon. I was chatting with the host at 1:00, saying how VIX was within 0.01 of its year low that morning, and by the time we went on air, it was about 2 points higher, if not more. And we've seen a few spikes in VIX, and my thesis right now is people are, especially as you get into a seasonally difficult time, and remember 30 days from early August is early September, I think people are getting a little more mindful of risk. Please push back upon that if you see fit, or let's put that theory to the test a little bit.
So I will say, one thing that stands out in terms of, what people have been doing this year is that we have seen a lot more hedging activity, particularly in VIX, right? So a resurgence in VIX options trading, just to kind of give you some volume numbers, right? Up 53% year over year in terms of VIX option volumes, average ADV of almost 780,000 contracts. I've got a lot of questions around kind of what is driving that, right? Why this renewed interest in buying VIX upside calls, call spreads, VIX, options trading this year compared to last year, when last year was a more volatile environment. To your point of kind of when you're talking about the market environment last year, the way I explained last year was, people buy hedges when there is exposure or risk to hedge or when there are gains to protect. And last year, what we had was you can say what you will, but I would say, Fed rate hikes and higher inflation was on everyone's radar coming into the year, right? So it wasn't really a true surprise. And what we saw throughout the year was, as you mentioned, institutional investors de-risking very steadily and significantly, and de-risking by moving to cash, right? So once you've moved to cash, you don't really need to spend premium or spend money to buy option hedges, right? So I think that kind of explained why last year we didn't really see much interest in buying put options on the S&P or VIX upside calls or call spreads. Whereas this year, particularly in the VIX, I would say people typically use VIX options as tail hedge, right? So to hedge for that black swan event, whether that is, COVID in February and March of 2020, whether that's Feb 18, whether that's, the global financial crisis, they want VIX options for that convexity exposure, right? For that potential explosiveness when VIX quadruples, quintuples, et cetera. And that is much easier to do when the VIX is trading in the mid-teens like it is doing today versus, obviously when it was in the mid or to high 20s, which was very much the range last year, right? So I think, but the very fact that the VIX has declined has actually made tail hedging more attractive using VIX options. So I think that's part of it. And the second part is I mentioned this year, as markets have rallied, as the macro environment has shifted, investors have had to put more money to work, right? They had to increase their allocation to equities, both discretionary strategies as well as systematic. So as they do that, that need for hedging also increases, and that's why you've seen this not just with VIX options but also with S&P options as well.
Someone brought to my attention some of the strategies that people have been using in VIX options, and you look at the volumes in 47 half calls and 60 calls and things of that nature. Some people going as high as 80 calls. I mean, that that is one hell of a tail risk. And to me, it's an interesting type of hedge, because that is purely a disaster hedge. Not even because you're not going to see that in a garden variety correction. You're only going to see that in a crazy scenario. What other strategies, VIX or not, are you seeing being very popular, resonating with investors these days?
Outside of the VIX, product complex, if we move on to S&P, I mentioned, right, like, an uptick in S&P, strategies. I think that is a function of the overall volatility environment declining, because, keep in mind that implied volatility is the number one driver of option premiums. So in an environment where implied volatility is lower, that means the absolute premium that you're paying for optionality has also gotten cheaper, right? So it's cheaper to hedge, but also cheaper for upside. And we're seeing, also an increased uptick in call volumes as well. And that's, I think, a function of the fact that people were not positioned the right way coming into this year, right? By far the most consensus position among all the investors I spoke to at the beginning of the year across US, Europe, South America, across regions, everyone was short US equities, particularly US, large cap tech. And that's precisely what has, led the rally this year. So, if you are someone who has been or was underweight equities, underweight US equities, right? An easy, efficient way to get that upside exposure is through, upside calls. So I think that's why I think that helps explain some of the volumes that we've seen on the call side as well. And then last but not least, how can I talk about S&P options without talking about, the 0-day options, right? And those remain very popular. So, consistently throughout this year, we've seen about 40 to 50% of all the volumes in the S&P being concentrated in those 0-day options.
That was going to lead into my next point, because I had a journalist call me yesterday and said, I've seen all this new activity in index options. How much of it is zero dated? And I'm like, well, probably most of it. Do you agree? Do you agree with? Did I give him the right answer?
So no, technically it's not most. It's
Yeah.
40 to 50. So it's
Okay.
substantial, but not
All right.
not more than 50.
Plurality, not a majority. Okay.
Yeah, but I will say I will use this opportunity to plug our upcoming white paper, which hopefully should be published, available to the public by the time this podcast goes live. We have put out a very comprehensive white paper on the 0 day, the trend of short dated options, particularly focusing on 0 day options, right? So looking at who's using it, why people may use these options, the volume profile, the intraday risk profile. It's a very comprehensive, but I would say also very easily digestible white paper. So I really encourage those who want to learn more about the space, to read the paper.
I love teeing up stuff like that. I'm looking forward to it. There have been two real pushbacks that people have had about zero dated options. I'm just going to use the term broadly for zero, under, let's call it sub 5. But, one is that zero dated options have injured VIX somehow. And I'll leave my personal opinion out of this one. I'll let you answer it. And the second one is that they bring systemic risk with them, which I have a very strong opinion on as well. And I will but I will defer to your answers because, again, the listeners have probably heard my opinions ad infinitum.
So I think the activity that goes on 0 day in 0 day options, it's very distinct from the typical volumes that we see in longer dated options, right? So for example, institutional investors coming to hedge, like we mentioned, right, recession risk, or they want to put on a hedge going to year end. That hedging flow, right, that's not going to be replaced by 0 day options, right? It's true that the VIX does not reflect the activity that's going on in these 0 day options, but we do have like a 1 day VIX currently, right, which gives you a better sense of the volatility that it's being priced and embedded and reflected in these extremely short dated products. So that's kind of my answer to the first point. The second point, the systemic risk. I mean, that's a question that we've gotten a lot, and I think there's been some very big headlines being made throughout the year, by people who think this could potentially lead to another Volmageddon or another big systemic event. And I would say for the most part, a lot of the analysis is based on incomplete or incorrect assumptions about who's trading these products and what they're using them for, right? So you read analysis, for example, that assumes that most people are short these, right? So if they're short these options, therefore, if the market really starts to move, there will be a scramble to cover, and that could exacerbate moves in the underlying index. Or you read that everyone's long. This is just another form of YOLO. Retail investors buying upside calls. It's just another extension of the meme stock craze, and therefore, market makers on the other side are all short, and therefore, when they start to hedge, that's going to exacerbate moves on the underlying. So those are kind of the various strains of kind of that argument. And the reality is that actually it's much more nuanced, and more importantly, it's much more balanced than that. So first, we find that it's in terms of who's trading it, it's a pretty even split between retail and institutional end users. We find that in terms of use cases, it's a pretty diverse set of use cases. Some people use these 0 day options for yield enhancement. So they're selling, capped call spreads, put spreads on the S&P for income generation. Other people are using it to hedge overnight risk. Other people are using it to play intraday momentum. It's a pretty diverse set. There are systematic strategies that are being active in this space. There are a lot of discretionary strategies. So it's very diverse. And then most importantly, the last point is it's very balanced between the buys and the sells, such that if you look at the net positioning across strikes, it's only a tiny fraction of the overall gross volume. So people look at the headline volume in these numbers and they think, oh my goodness, the risk must be huge, right? But because it is so evenly balanced between, buys versus sells, the net risk, the net positioning is actually minuscule compared to the gross, volume number. And that's something that, we do go in detail in the white paper. So again, for those who want to better understand this product and the space, I do recommend everyone to read the paper.
First of all, if you were sitting in the room with me, I'd have given you a big high five along the way because that really syncs up with what I'm thinking. And I really can't wait to read this. That's not blowing smoke. I really do want to see it because, a couple things that I'll now add are, I do think I've said all along that I think that the players or the strategies used among short dated option traders are different than the people using 30-day options or VIX, et cetera. So we're in sync on that one. And I think that I've also been, I think, quite vocal in saying that I don't think these have any, they don't add systemic risk at the risk of insulting an exchange, which I don't want to do. My original read was the games haven't changed. They've just added more tables at the casino. It's really just a different set of strategies. And I think the more dire the prediction, my feeling is the less that they've actually been up to their armpits, either as a market maker, as an exchange professional, or as a clearing professional, risk manager, et cetera. I think a lot of them have come, from 40,000 feet saying these seem really dangerous, but they're using very well established, risk protocols. I think there is the potential for sort of one day, I'm not going to say hiccups even, but exacerbate moves on an intraday. And I do think we've seen that, particularly on some of the big upside days. But I think also as the product evolves, I think that those who are inclined for income realize that the best day to write an option, that decays, fall off exponentially. So the shorter the option, there's very few guarantees in life, but I'll guarantee you there's no extrinsic value in the option after expiration. And I think people pick up on that idea.
Right.
So going into the end of the year, what are you focused on? What do you think the opportunities are for people in the option space, or investors in general?
Yeah, sure. So when I look, across asset classes, and I think I mentioned or alluded to this earlier, but what really stands out to me is, interest rate volatility, right? Bond market volatility. That is still the only asset class where volatility is near extremely elevated levels, near historic levels. It has, has come off the near all-time highs that we saw last year, but it, still remains very rich. That again is really a reflection of Fed policy uncertainty. Specifically within the bond market, what I'm watching is, well, one of the things I'm watching is, the SOFR curve, right? And the fact that the market has persistently priced about 140 basis points of cuts for next year. That really hasn't changed much at all over the past couple of months outside of the March, banking crisis period. So this persistent belief that the Fed is going to start cutting rates, at the first sign of economic weakness, that, inflation is over, or that, the Fed's going to shift focus from fighting inflation to supporting growth, that remains to be seen. And then one asset class I think that's going to be really interesting to watch is going to be credit, right? Corporate bonds, as we all know, have both duration risk, so interest rate risk sensitivity, as well as credit risk, right? So that's, reflected in the macro outlook. So that's an asset class I think that's kind of right at the crossroad of everything that we're talking about. In particular, it's not just that it's sensitive to duration risk and credit risk, but also the correlation between the two. So when we have a year like, last year, 2022, where you had rates going up because of Fed tightening, and you had, spreads going up because of the increase in recession risk, right? So when the two kind of move in the same direction, you had, last year a record sell-off in investment grade bonds. IG bonds actually sold off more last year than the S&P, despite being quote unquote lower risk, right? And that's why last year, if you look at high yield corporate bonds, right, HYG, implied volatility, more than quadrupled from a low of 4 at the beginning in January to over 20. Right. So and both of those underlyings, vols have come in quite a bit this year. So kind of going forward, the question is, what's going to happen with that correlation between duration and credit risk? Could we see a repeat of last year if inflation proves to be more sticky? And to that end, one thing I do want to highlight and shout out on this call is the fact that we have launched options on both iBoxx investment grade, as well as high yield futures, corporate bond futures. So IBHY, which is the high yield iBoxx high yield index, and IBIG, which is the investment grade corporate bond index futures. Those have been live for a couple of years now. Early last month, we launched options on futures, which, again, allows you to play the volatility in these underlying assets. And just two things, I'll be really quick to highlight on that. One is that by design, these futures and options on futures are designed to tap into the liquidity in the underlying ETF ecosystem. So a lot of questions I get is, like how liquid are these products? Is it going to be as liquid as, the ETFs? By design, these futures are designed to track the holdings in the ETF, and as a result, allow market makers to hedge with the underlying ETFs. And that, I think, really enhances the liquidity in these products. And the second is, why trade options on these futures when you can trade them on the ETFs? And I would say, particularly for those who are looking at selling options in credit and corporate bonds, two complaints that we've often gotten, or drawbacks that we've gotten with those products, is that ETF options are American style, and they're physically settled, right? And because they pay a very high dividend, you have pretty substantial early exercise risk. And that's something that, on the options on futures, because it's, the underlying futures are cash settled, because it's on a total return index, you don't have that dividend risk. You do, mitigate a lot of that with options on futures. So that's something that I'll leave you with. I do think, corporate bonds as an asset class is something, to really watch the next year as we enter potentially, a different, rate regime, and particularly options on corporate bonds. I think that would be very exciting.
I think that sounds like a very interesting product, and I do think that the distinction between cash settled and deliverable, what your deliverable is underappreciated, and I think a lot of institutions know from that, but I don't think a lot of individuals appreciate it. I think many of them have learned as they've started to trade SPX short-term options, but there are distinct advantages in that. I think I've written something about it, and I'll drop it in this for our listeners if I have it.
Perfect.
Mandy, this was a real eye-opener, and I hope this is the first of several dialogues that you and I can have on the topic. For everybody who's listening, if you've just tuned in now, shame on you. We've been talking to Mandy Xu, VP and Head of Market Intelligence Data at the Cboe, and we've been having a great discussion, and hopefully this is chapter one in an ongoing discussion.
Looking forward to more. Thank you.
And just give a shout out for some of the stuff and where they might be able to find the stuff that's out there. Some useful Cboe links if they don't already have them, or if there's any that you have at your disposal.
Yeah, will do. Yep.
And on that note, I wish you all farewell. This has been the latest edition of IBKR Podcasts. Please tune in next time and look for this one, as well as all our other podcasts at all your favorite podcast destinations, including, of course, IBKR Campus and IBKRpodcasts.com. Thank you, everybody. Take care. Bye-bye.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.